Hey gang, this episode is sponsored by Fabric by Gerber Life. Fabric by Gerber Life was designed by parents for parents to make it easy to plan for and manage your family's financial path. With a kid's investment account from Fabric, you can start investing in your child's future today. The cool thing is that this is an online account and you can set it up. It'll take you about 5 minutes, honestly. It's maybe $1 a day is like the minimum, is a little bit, you should put more in. Now, remember, kids, they can't invest when they're minors. So an UGMA, a Uniform Gift to Minors Act account, this can allow you to invest on their behalf, but you can also teach them about investing and also give them plenty of time for that investment to grow. Invested funds can be used for education, plus anything else like summer camps, band equipment, clubs, sports. That is so expensive now. And when they're adults, they can use the funds for their first home or maybe even to start their own business. There are no contribution limits. There are multiple tax advantages, and they're SIPC insured up to $500,000. No commissions, just a low, flat monthly maintenance fee. So go to meetfabric.com/Jill and start investing in your child's future today. That's meetfabric.com/Jill, MEET, fabric.com/Jill. Welcome to Jill on Money, powered by The Compound. I'm Jill Schlesinger. I'm a certified financial planner and a media talking head. Mark Talercio is my executive producer, also a certified financial planner. Hi, Mark.
Hello, Jill. Good morning.
How you doing?
Like I was telling you before we started, I am doing well. It's early October, maybe mid-October by the time this runs. Who knows? But it's feeling fall-like.
And you know what happens in the fall? Everybody sends their kids to school, and then they can reconcentrate. They can re-engage with their financial priorities. And one of the big questions that we continue to get is one of those, kind of meat and potatoes questions, which is worth going over. What is the difference between a mutual fund and an exchange traded fund? Now, I know a lot of people, they like the whole mutual fund universe because you're used to it.
Mm-hmm.
And a mutual fund, pooled investment that is going to be investing in something. It can be a bond, it can be a stock, it can track a stock market index, a bond market index, a commodities index, can do all sorts of things. Now, the thing that's always interesting about a mutual fund that many people don't realize is that mutual funds, you can buy it during the day, but it doesn't matter what's going on during the day, because by the end of the day, that's when the pricing. So the pricing of a mutual fund occurs at the end of the day.
Right.
Okay. So with an exchange traded fund, that's not what's going on.
You can trade it.
You can trade
it
in like as if it were a stock.
Yeah.
And it's sort of like this amazing ability where people can trade or buy at intraday, maybe take advantage of something that's going on, or maybe just know that your order has actually been executed. Now, the thing is, when exchange traded funds first were rolled out, I was kind of like, don't be trading those in the middle of the day because there were costs associated with it. No longer. So now when you have an exchange traded fund and you buy something in the middle of the day and you sell it 2 hours later, for most people, there's no cost involved in that at all. So Mark, where do you lean? Mutual fund or exchange traded fund?
I mean, for me, you're not going to go wrong either way. It really depends on what you're doing. I mean, our listeners, the people that watch Jill on Money and listen to Jill on Money, they're not really traders. So I would just say, just stick with an index fund. I mean, yeah, ETFs might be slightly lower expense ratio. And if you want to use an ETF and just use that and not trade, that's fine too. You're not going to go wrong either way. They're basically the same thing.
How do you feel about people who are trading intraday and betting on directional parts of the market, or even, a lot of exchange traded funds? There are new permutations of those. So talk about something that is antithetical to my world and where I come from. There are certain exchange traded funds that have leverage. There are certain exchange traded funds that bet against the overall market.
No.
Guys, I think this is a loser bet for you, and you may try to do it. Good luck. But if you want to do that with a small fraction of your invested assets, fine with me. And we just recently got a question from somebody who had a 15% position in one stock.
That was at Tesla?
That was Tesla.
Yes.
And we talked about how hard it is to convince people who have had big gains in something to sell. And I think that with an exchange traded fund, I worry that people fall into those same traps, that there's a belief that you know better. So what is my rule of thumb when it comes to individual stocks or one concentrated position is no more than 5 to 10% of your invested assets. And that goes for your company stock. I was just reading an interesting note about one of the big CEOs of an investment bank who said, he was selling some stock. And one of the things that he said was, of course I'm selling stock. Why would I have a one position that dwarfed every other part of my entire wealth? And so if that's good enough for someone who runs a large investment bank, probably good enough for you.
You know, I was just looking, because we were talking about this recently on the show. We've gotten a lot of these questions lately, but I was looking at my wife's total allocation in her portfolio. And right now, her company, 20%.
Ooh, so
But I can't do anything about it right now because nothing's vested yet. So it all starts coming off the books at the beginning of next year. And as soon as I can get my hands on it.
So I would not, just to be clear, when it comes to that, like vested or even options that are not yet in the money, I would not count that as part of my portfolio until it vests.
I know you don't.
Just in case.
But some of this stuff is cash grants as well.
Oh, I like cash grants.
Yeah.
In general, I like cash,
Yes.
just in case you were wondering.
But a lot of it is company stock, and it all starts vested next year.
Okay, last question, though.
Go.
Last question. How do you feel about people who are now carving up the exchange-traded fund world and buying actual managed exchange-traded funds, just like they would buy a managed mutual fund, not an index?
Yeah, it's probably a waste of money.
That's what I think.
It's probably a waste of money. It's just like, a managed portfolio versus passive. But I will say, because a lot of people out there, they do have ETFs, and they didn't probably realize what the difference is. And if you are just a passive investor and you have ETFs, that's
Great.
totally fine. We're not saying you have to ditch them and go into index funds. You can keep everything as is. It's not a big deal. Basically, unless you're trading, an ETF versus an index fund, same thing.
Pretty close. And we don't like managed versions of either of those unless it's this very esoteric part of the market, like small cap value Chinese stock fund, which I wouldn't buy. But I'm just saying, if that were the case, then maybe there is some evidence that managed funds work well in thinly traded markets. But I stay away from those anyway.
Where the managers have what they should have, a very intense focus on that specific area.
Exactly. Otherwise, index funds, index exchange traded funds, go for it. All right, that's it, Mark. If anyone of you has a question about a mutual fund versus an exchange traded fund versus anything else, or you want to keep that huge position in that one company, give us a holler. Go to JillOnMoney.com, click the Contact Us button. We'd love to hear from you. Thanks for watching. We'll see you next time.